Welcome, folks. Brandon Chapman with you today. It's another Theo Night video for Monday, May 16th, 2022. The title of today's session is Bernanke Skewers Powell as market pauses, VIX falls, and commodities pop. Bernanke's out there skewering Powell, saying, oh, he didn't shock the market. He was too accommodative. He was afraid the market would fall. Calling him a coward? Are you serious? I'm like, here's Ben Bernanke, Helicopter Ben, talking about somehow should have done more to shock the market. Boy, you look at, for example, IRX as a proxy for interest rates. Let's go back, 20 years. Hey, why not? Let's go to a monthly chart. Say, okay, Bernanke kept interest rates at zero from what? 2009 through 2015. And only leading in the election, they began to raise rates again. I mean, this is so ridiculous that all of a sudden Bernanke's calling out Powell saying he's not doing enough to shock the market, taking inflation seriously. You know what? I understand. Yeah, we're having commodity inflation right now. But you know what? We had tremendous asset price inflation during Bernanke's tenure as well. And of course, it's kind of funny how these Fed heads or Fed presidents, they get removed, they step down, they let someone take off. All of a sudden, they try to reconstruct their legacy somehow, like Bernanke did, for example. I mean, my goodness. Like Greenspan did, for example. I mean, if there was a guy that departed from his historical kind of writings, his essays, for example. I mean, my goodness, you didn't recognize the 60s Greenspan with the 2000 or late 90s Greenspan. Very, very different. Bernanke's probably the same way. And again, we're seeing he's taking pot shots at Powell, saying it was a mistake not to shock the market. And I think we've talked about this before, but once inflation expectations are ingrained in people's psyche, what's the important thing to do? According to Fed head policy, shock the market, raise rates. My goodness. Okay, yeah, back here we raise rates a little bit, but look what happened when oil prices, for example, during Bernanke's tenure, spiked to 140. He was providing the same type of excuses and, in fact, began to raise lower rates in 2008. There's not a seriousness right now with regards to monetary policy, and there historically is not. And so we've got to understand what's going on. And as we look at the S&P today, for example, we're basically unched. I mean, we're down about 0.4% at the moment. But if you look at the candle today, we're opening and closing at virtually the same price. It's called a spinning top, kind of a doji here in the middle of yesterday's range. We could easily break higher and maybe roll towards 415 or 420, 430. Who knows, right? Point being is that we're in a very, very difficult position. Now, I'm going to provide a bullish and bearish argument here. The bullish argument says, look, well, the VIX is declining here, right? We had a big down day on Friday. We're down nicely today as well. We're rolling towards 25. I think we're going to have a hard time getting below 25 is the first point. But the fact we're seeing more mobility in the VIX is important. We're going to see mobility to the downside, but more importantly, we have the potential to see mobility to the upside. And why am I saying that? Because if we look at Skew as an example, Skew has declined, right? If we look at a line chart here, we ticked up slightly here in Skew. We're down at 122. So as the VIX has been rising in recent and been muted to the upside, because we had high Skew over the last little over a week, we've seen Skew decline, and we're in a better position right now to, number one, see more explosive moves to the upside and maybe less to the downside until what? Until something breaks again. The fact of the matter is we're in a very, very different position today than we were, for example, back in February. Okay? Similar type posturing here, except for the Skew is higher. But right now what we're seeing is that Fed is much more inclined to raise rates, 50 basis points a meeting. Maybe they do shock things and raise more than 50 basis points. But what they do realize is that right now, inflation is structural, meaning that we cannot solve the supply issue. Powell's talked about two different types of inflation being supply issues and the other maybe asset price inflation. Yes, they can do something on asset price inflation. Look at what the market's done as they've turned more hawkishly on the policy side. Yeah, it's not to Bernanke's liking. It should be quicker. I agree with that part of it, but I don't think Bernanke would have done anything different if he were in this position. Okay, but the point is is that we may see the market drift higher, okay, in the near term. But the reality we have to understand is there is downside risk because of why? Recessionary pressures. The Empire State Manufacturing Index was not good this time, this round. We've had a lot of bearish data points, including a negative GDP. And today we are seeing rising commodity prices. I mean, there is significant pressure. Oil is now at 114. Maybe we're en route to 130 or higher here, as some of the policy decisions over the last couple of months are taking hold in a very, very undersupplied energy market. Also, canceling, the lease sales. My goodness, so we're reducing our potential to produce in the future at a point when supplies are low and below the 5-year range. And all you got to do is look at the forward/CL, look at this red line that's sitting in backwardation right now. And you know the story. We are very undersupplied. The risk is to the upside in oil and also agriculture. For example, forward/ZW, up almost 6% today. We're going to quickly get back to the highs at around 1364. Why? Well, again, we have a lot of the wheat production that is offline. Wheat supplies offline. Lack of exports from India and Hungary, etc. We're becoming isolated. We're relying more on our production. And again, as a function, wheat prices are rising. And in fact, on wheat, WEAT, it's an ETF. Last Wednesday, I talked about it for our members in my session and in our at the close, which occurs after the market hours, June 12 call activity in wheat last Wednesday. This has gone from 11.25. It's up near $1, which is pretty decent for a product like this. As a result, you look at DBA, for example, exploding higher today, up nearly 3%. You look at USO, an oil ETF, up nearly 2.25%. You look at DBC, that kind of wraps them together, more of an oil focus, again up 1.64%. So we're seeing an upward bias. So any advances you might have seen or improvements you saw in CPI, the headline CPI number last week, inevitably they're going to go away as long as commodity prices keep rising, because the lower number occurred because why? We saw a little bit of a decline in energy and food. Again, those are the two areas that are probably going to continue to increase, maybe volatile, but we may see them increase for the foreseeable future until we start to see supplies come online. As we look at the bond market right now, TNX, 10-year yield was down slightly. Again, we may be positioning here towards support. We may see things run. As you look at TYX, that's 30-year treasury yields, was actually off a little bit less. Looking at TLT, actually some unusual option activity in TLT today. It was a December expiration, so we go out here for December. Again, not immediately impactful out here, but look at the puts. 5,000 contracts mostly bought at the 90 strike for 16 December. So again, some people putting some feelers out there for some bearishness in TLT. My thought process is I think we're probably going to see TLT start to dig in here and may eventually begin to rise. Recent auctions have been better in terms of foreign demand, which unfortunately does potentially mean a stronger dollar, which the dollar was down slightly today. However, that's mostly against the euro. When we look at GLD did bounce. This really gives you more of a true reflection of dollar strength or weakness. Now, ironically enough, Ben Bernanke took pot shots at gold and Bitcoin today. He says, well, yeah, you can use gold to fill your teeth. He's relaying, the crony capitalist in chief, Warren Buffett, in terms of the barbarous relic of gold. But the reality is real money does serve a purpose, and gold does become real money in this circumstance. They fail to recognize the store of value, the medium of exchange that this provides, because it's divisible, it's rare but not true rare. There's a lot of things that go into gold, but the reality is the dollar's strengthening right now. Gold absolutely should decrease in price. We're seeing a little pop today because the dollar decreased in value. So we're going to see a bit of a whipsaw. It's not as natural market. You don't have demand that's shifting or supplies that are shifting greatly like you're seeing, for example, in oil. It's a totally different market. And what we're going to see right now is gold will not, or is going to have trouble moving with oil and agricultural commodities because they're undersupplied, right? We're seeing shifts of curves. And the point is prices are going to go higher because we are seeing shortages. We don't have shortages of gold, for example. And as a function, it's going to be succumb to whatever direction the dollar goes. And again, with inflation rising, the Fed looking to raise rates, and also what's going on globally. Japan failing to move, for example. Europe failing to move, for example. You look at the US dollar / JPY. This may break out again, which would be very disastrous for the Japanese central banks and government in terms of their policy failures, as we've seen over the last couple of months here. But the fact of the matter is, there's not a real driver for gold to go higher here. Because again, we can't look at inflation as a result of supply issues versus inflation being too many dollars. There are too many dollars. But right now, the Fed is trying to soak up. They're going to reduce the money supply, and it's likely going to get away from them and create a shock of an opposite direction where all of a sudden risk assets start to see a major contraction. And that's the point where the Fed may step in and go easing again. But as of right now, there's not really a mechanism for creating higher oil prices. Higher gold prices. And as a function, Bitcoin. I mean, my goodness. I mean, he had some really nice things to say about Bitcoin, for crying out loud, right? He says it's not going to take an effect as an alternative form of money. It's only been successful as a speculative asset. And again, seeing downside right now. But if Bitcoin were a substitute for fiat money, you'd use Bitcoin to go buy your groceries. And again, he's talking about you can't do that right now. And again, groceries, but you know what? I mean, buying higher priced items is definitely reasonable, right? But the bottom line is, this guy is just blasting Bitcoin because why? It is a threat to his, and again, the moneyed classes' emphasis on inflation. And again, it's just a tax on the people, right? But he talks about the underlying value of Bitcoin is due ransomware or something like that. And here's the deal, right? People talk about, they're being used for illicit purposes. I mean, my goodness, what currency out there is probably used for more illicit transactions than any other? And it's got to be the dollar. And you could probably look at the money centers of the world and find more illicit activity in dollar terms than you see in Bitcoin or other cryptocurrency. So again, it's easy to take pot shots on something that right now is under some pressure, and rightfully so. We're draining the pool of liquidity. There is leverage in Bitcoin. The dollar is strengthening. Those are not great dynamics that are going to bullishly affect Bitcoin. In fact, today in BITO, it's an ETF. If we look at BITO, it's a July expiration. Let's come down here. July 16th. So put option buying in the contract, $16, 15 July 22 contract. So, people are taking bearish trades right now, right? There's been some big bullish trades out of the money, anticipating the Fed is going to reverse policy this year and gold's going to go shooting up. Again, Powell will likely follow Bernanke at some point and go easy. Helicopter Jerome at some point, maybe even this year. There's been trade in the gold markets that have certainly pointed to that, but you're going to have to exercise some serious patience. As we look at Oxy right now, Oxy today up nearly 6%. It's also a company that has higher short interest, along with RIG and some other ones right out there that are CDVE, I think. No, is it CDEV? Sorry, Continental Resources. There's a number of commodity oil-related companies out there that have higher short interest. And that's really what we're talking about right now, right? As skew is coming down, we're opening up the potential squeeze to the upside. And when you start to look at high short interest stocks, you'll see energy. Yeah, that's a high beta space right now, and there's a lot of short interest there. Healthcare, not so much so. Staples, utilities, those are kind of defensive sectors, right? If you look at SPHB, this is a high beta. It's down 1.5%. But you focus on companies that have high short interest, and this is by no means a complete list. You start to see some big moves in companies like Sundial Growers, for example, and GRWG. These are companies that are in the cannabis space. And of course, today in TLRY, for example, TLRY saw some bullish activity on a May expiration in here. Look at all this volume amassing out of the money, 556, 5. So again, a lot of buying interest, open and close, day trading in here. But look at the volatility skew, right? Rising in volatility makes this a great opportunity to buy and sell, right? Constructive vertical. Could this thing go to $6.50, $6, $7 in the next few days? Absolutely it could. Again, these are the kinds of companies that can get squoze to the upside, and that positive vol skew is certainly reflective of that potential. You're not necessarily seeing that in a Carvana. Let's look at Carvana. This is a high short interest stock, but look at a May expiration, 4 days left. Look what's happening here. Volatility is declining. You're not seeing the real significant speculative activity out here, short dated for a 20 May. There's no real expectation of immediate short squeeze, but there was some activity today out in the June expiration, an upside call spread buying the 50 and selling the 70. Look at the implied volatility. Again, it was pretty flat. Again, no real pricing advantage, but it's just saying, hey, I think Carvana may squeeze higher to 70. But what you're not seeing is that activity out there that suggests there's a lot of hedging upside activity, and that's why these vol skews are not, there's not really a strong positive vol skew, whereas the S&P generally has a negative vol skew priced in, where you have higher puts, lower price calls. This has a negative price skew, higher price puts, lower price calls. Again, going back to TLRY, let's just look at CGC today. Also had some bullish activity for a May 650. Let's look at the May expiration here. Right here at the 650 strike. Are we seeing positive skew? Declining vol there, rising vol out here. Again, very cheap spread. So if you're trying to take a very low probability trade that we might see a little bit of a squeeze. Again, CGC did fade back towards the end. The sundial growers as well, where some of these cannabis trades may squeeze higher. Something to watch for, right? We do have maybe some earnings coming up here on 5/16 on sundial growers, which I guess is after the market closed today. Let's see if there's any after hours activity. It's down a little bit, so no real movement there, no real volume as well. So may not have that news if there is any news here. This has been obviously off a little bit. Anyway, so you get the point here, right? So high short interest companies that have positive skew, rising call implied volatility, that is a way to speculate to the upside with very, very limited risk. And again, low probability trades. If you're looking for some areas that are better, we're looking at what? We're looking at energy. Southwestern Energy. We got CDEV in here. We've got Oxy. You got RIG. You got a number of these bullish trades that are in the energy space that also have higher short interest as well. Now, as we look at companies like Apple, these monsters of technology that generally influence the market greatly, you'll notice Apple today, again, spinning top, just looks just like the S&P. I mean, if the market were to make a major move higher or a reasonable move higher, you'd imagine Apple would participate. And you're seeing some activity in Apple that suggests somebody are taking some positions based on that possibility. You look out here at the 155 strike, for example, 15,000 contracts, mostly bought in one print, close to about 10,000 contracts, like 9,800, for example. You can easily see this down here under time and sales. It'll take a second to load there. 98.20 bought in one print. It's a $4 million trade. This is not some small fry in here coming in, but it is somebody that wants to say, if the market's going to go higher, Apple should go higher. There's also in here a bullish synthetic, buying the call, selling the put. You'll see that reflected here as well, 10,000 contracts in one print. So my point in sharing this is saying, look, Apple may move higher sympathetically if the market finds some grounding and moves higher. But if the market just kind of consolidates here, there's a chance we continue to see short squeezes in some parts of the market, and also companies that are having some good news. So for example, in Eli Lilly, breakout today did fade back towards the prior high, but did get some positive news regarding their diabetes drug, which I guess is going to get approved. It targets two hormones, could be used as dietary, weight loss kind of supplements or medicine as well. So again, there's some things to look at there. AT&T, again, there is this looking at value and dividends. So AT&T obviously cut their dividends. They're not a dividend aristocrat anymore, but they do pay 5.5%. They're probably going to be slow to lower the dividend. And as a stock kind of broke out today of a symmetrical triangle, you look at the range here from about 19 to about 20.5. That's about $1.50. We might have a chance of maybe breaking out to about 21.5 up here, which carries about 423% projection based on this initial move back here. So again, there's some stocks you can look at. Utilities were higher today. Nextera is one that had some bullish activity last week. Maybe we find some grounding. But the nice thing here is you're close to a support level that if we break, we may head significantly lower. So if we kind of break this area here at about 68, 68 and a half, you might want to sell it, buy it back at a lower price again. Anyway, so folks, that's the wrap today on Monday's video. We'll catch you back next week on the Theo Night video. Thank you. Have a good one.